Welcome to our comprehensive guide on understanding the different types of bonds. Bonds are a fundamental part of the financial world, serving as a way for governments, corporations, and other entities to raise capital. In this video, we'll break down what bonds are, why they matter, and how they fit into the broader investment landscape. Whether you're a beginner or looking to refresh your knowledge, this guide will help you grasp the essentials and make informed decisions. Let's start by exploring the basic concept of a bond and why investors consider them a key component of a diversified portfolio. At its core, a bond is a type of loan. When you buy a bond, you're essentially lending money to the issuer, which could be a government, municipality, or corporation. In return, the issuer promises to pay you interest at regular intervals and to return your principal at the bond's maturity date. Bonds are often considered less risky than stocks, making them a popular choice for conservative investors. Understanding how bonds work is the first step to navigating the world of fixed income investments. Before diving into the various types of bonds, it's important to understand some key features that all bonds share. These include the face value, which is the amount the issuer agrees to repay, the coupon rate, which is the interest paid to the bondholder, and the maturity date when the bond comes due. These features help determine the bond's value and the income you can expect to receive. Knowing these basics will make it easier to compare different bonds and choose the right one for your needs. Government bonds are issued by national governments and are often considered the safest type of bond. These bonds are used to fund government spending and projects. Because they are backed by the government, they typically offer lower yields but come with lower risk. Examples include U.S. Treasury bonds, UK gilts, and Japanese government bonds. Investors often turn to government bonds during times of economic uncertainty for stability and predictable return. Let's take a closer look at Treasury bonds, which are issued by the U.S. Department of the Treasury. These bonds come in various forms, including Treasury bills, notes, and bonds, each with different maturities. Treasury bonds are highly liquid and are considered virtually risk-free since they are backed by the full faith and credit of the U.S. government. They're a staple in many investment portfolios, especially for those seeking safety and steady income. Municipal bonds, or munis, are issued by states, cities, and other local government entities. These bonds help finance public projects like schools, highways, and hospitals. One of the main attractions of municipal bonds is that the interest income is often exempt from federal income tax, and sometimes state and local taxes as well. This makes them especially appealing to investors in higher tax brackets. However, the risk level can vary depending on the issuer's financial health. Corporate bonds are issued by companies to raise capital for business operations, expansion, or other needs. These bonds generally offer higher yields than government bonds, but they also come with higher risk. The creditworthiness of the issuing company plays a big role in determining the bond's interest rate and risk level. Investors need to assess the company's financial health before investing in corporate bonds to ensure they're comfortable with the associated risks. High-yield bonds, often called junk bonds, are corporate bonds with lower credit ratings. Because of the increased risk of default, these bonds offer much higher interest rates to attract investors. While they can provide significant returns, they are also more volatile and can lose value quickly if the issuing company faces financial trouble. These bonds are best suited for investors with a higher risk tolerance and a desire for potentially higher return. Investment-grade bonds are those with higher credit ratings, indicating a lower risk of default. These can be issued by both corporations and governments. While they offer lower yields compared to high-yield bonds, they provide greater security and are often favored by conservative investors. Rating agencies like Moody's and Standard & Poor's assign these ratings, helping investors assess the risk level before making a purchase. Zero-coupon bonds are unique in that they don't pay periodic interest. Instead, they are sold at a deep discount to their face value and pay the full amount at maturity. The difference between the purchase price and the maturity value represents the investor's return. These bonds can be attractive for long-term goals, such as saving for college or retirement, but they do not provide regular income along the way. Convertible bonds are a hybrid security that gives investors the option to convert their bonds into a predetermined number of shares of the issuing company's stock. This feature allows investors to benefit from potential stock price appreciation while still receiving bond interest payments. Convertible bonds typically offer lower yields than regular corporate bonds due to this added flexibility. Callable bonds give the issuer the right to redeem the bond before its maturity date, usually at a set price. This feature is beneficial for issuers if interest rates fall, as they can refinance their debt at lower rates. However, for investors, callable bonds carry the risk of having their investment returned earlier than expected, potentially at a less favorable rate. It's important to understand the call provisions before investing. Puttable bonds are the opposite of callable bonds. They give the bondholder the right to sell the bond back to the issuer at a predetermined price before maturity. This feature provides investors with added flexibility and protection if interest rates rise or if they need to access their funds sooner. Puttable bonds generally offer lower yields compared to similar bonds without this feature. Bonds can be classified as either secured or unsecured. Secured bonds are backed by specific assets, providing extra protection for investors if the issuer defaults. Unsecured bonds, also known as debentures, are not backed by collateral and rely solely on the issuer's creditworthiness. Understanding this distinction is crucial when evaluating the risk associated with a particular bond investment. International bonds are issued by foreign governments or companies. These bonds allow investors to diversify their portfolios geographically and potentially benefit from currency fluctuations. However, they also come with additional risks, such as political instability and exchange rate volatility. It's important to research the issuing country's economic and political environment before investing in international bonds. Emerging market bonds are issued by governments or companies in developing countries. These bonds often offer higher yields to compensate for the increased risks, such as political instability, economic volatility, and less established legal systems. While they can enhance returns and diversification, investors should carefully assess their risk tolerance before adding emerging market bonds to their portfolios. Inflation-linked bonds such as Treasury Inflation-Protected Securities (TIPS) are designed to protect investors from inflation. The principal value of these bonds increases with inflation, ensuring that your investment maintains its purchasing power over time. These bonds are especially attractive during periods of rising prices as they help preserve real returns. Subordinated bonds, also known as junior bonds, are lower in priority compared to other debts if the issuer defaults. This means that in the event of bankruptcy, holders of subordinated bonds are paid after senior debt holders. Because of the higher risk, subordinated bonds usually offer higher yields. They are often issued by financial institutions and can be an option for investors seeking higher returns with a willingness to accept more risk. Perpetual bonds, or PERPs, have no maturity date. They pay interest indefinitely, making them similar to preferred stock. These bonds are rare and are usually issued by financial institutions. While they can provide a steady stream of income, the lack of a maturity date means investors may never get their principal back, so it's important to weigh the pros and cons before investing. Green bonds are issued to fund environmentally friendly projects, such as renewable energy, clean transportation, or sustainable agriculture. These bonds appeal to socially conscious investors who want to support positive environmental impact while earning a return. Green bonds are becoming increasingly popular as more investors prioritize sustainability in their portfolios. Social bonds are similar to green bonds but focus on funding projects with positive social outcomes, such as affordable housing, education, or healthcare. These bonds allow investors to align their investments with their values, supporting causes that matter to them while still earning interest. Social bonds are part of the broader trend toward responsible and impact investing. Sukuk are Islamic bonds that comply with Sharia law, which prohibits charging or paying interest. Instead, Sukuk holders receive a share of profits generated by the underlying asset. These bonds are popular in Muslim-majority countries and offer a way for investors to participate in fixed-income markets while adhering to religious principles. Catastrophe bonds, or CAT bonds, are issued to raise funds for insurance companies in the event of natural disasters like hurricanes or earthquakes. If a specified catastrophe occurs, the bondholders may lose some or all of their principal. These bonds offer high yields to compensate for the risk and are typically used by sophisticated investors seeking diversification. War bonds are issued by governments to finance military operations during times of conflict. These bonds have historical significance, especially during World Wars I and II, when citizens were encouraged to buy them as a patriotic duty. While not commonly issued today, war bonds played a crucial role in supporting national efforts during wartime. Savings bonds are low-risk, government-issued bonds designed for individual investors. In the U.S., Series E and Series I savings bonds are popular options. They are easy to purchase, require a small minimum investment, and are backed by the government. Savings bonds are often used for long-term savings goals such as education or retirement, and are a great way to introduce new investors to the world of bonds. Foreign currency bonds are issued in a currency different from the issuer's home currency. These bonds expose investors to currency risk, as changes in exchange rates can affect returns. However, they also offer opportunities for diversification and potentially higher yields if the foreign currency appreciates. It's important to understand the risks and rewards before investing in foreign currency bonds. Step-up bonds feature interest rates that increase at predetermined intervals. This structure can be attractive in a rising interest rate environment, as investors benefit from higher payments over time. However, these bonds may be callable, meaning the issuer can redeem them early if rates fall. Step-up bonds offer a way to hedge against interest rate risk while still earning a competitive return. Floating rate bonds have interest payments that adjust periodically based on a reference rate, such as LIBOR. This feature protects investors from rising interest rates as their income increases when rates go up. Floating rate bonds are popular during periods of economic uncertainty or when interest rates are expected to rise. Dual currency bonds pay interest in one currency and principal in another. This structure can offer higher yields and appeal to investors looking to speculate on currency movements. However, dual currency bonds carry significant exchange rate risk, so they are best suited for experienced investors who understand the complexities of currency markets. Structured bonds are complex securities that combine traditional bonds with derivatives or other financial instruments. They can offer customized risk and return profiles, but they are also more difficult to understand and may carry higher fees. Structured bonds are typically used by sophisticated investors seeking specific investment outcomes. Covered bonds are issued by financial institutions and backed by a pool of assets, such as mortgages. These bonds offer extra security for investors, as the assets can be used to repay bondholders if the issuer defaults. Covered bonds are popular in Europe and are considered a safe investment option within the fixed income market. Asset-backed securities, ABS, are bonds backed by pools of assets such as car loans, credit card debt, or mortgages. These bonds allow investors to gain exposure to different types of consumer debt. While ABS can offer attractive yields, they also carry risks related to the underlying assets, so it's important to understand what's backing the bond before investing. Mortgage-backed securities, MBS, are a type of asset-backed bond where the underlying assets are home mortgages. Investors receive payments derived from the mortgage payments made by homeowners. MBS played a significant role in the 2008 financial crisis, so it's important to carefully assess the quality of the underlying mortgages before investing. It's important to distinguish between callable and non-callable bonds. Callable bonds can be redeemed by the issuer before maturity, while non-callable bonds cannot. This distinction affects the risk and potential return for investors. Callable bonds often offer higher yields to compensate for the risk of early redemption, while non-callable bonds provide more predictable income streams. Bond ratings are assessments of a bond's credit quality, provided by agencies like Moody's, S&P, and Fitch. These ratings help investors gauge the risk of default and make informed decisions. Investment-grade bonds have higher ratings, while high-yield or junk bonds have lower ratings. Understanding bond ratings is essential for evaluating the risk and return profile of any bond investment. Bond yields and prices have an inverse relationship. When bond prices rise, yields fall, and vice versa. This dynamic is influenced by changes in interest rates, inflation, and market demand. Understanding how yields and prices interact is crucial for managing a bond portfolio and anticipating how market movements can affect your investments. While bonds are generally considered safer than stocks, they still carry risks. These include interest rate risk, credit risk, inflation risk, and liquidity risk. Each type of bond has its own risk profile, so it's important to understand these factors before investing. Diversifying across different types of bonds can help manage risk and achieve more stable returns. Unladdering is an investment strategy that involves buying bonds with different maturities. As each bond matures, the proceeds can be reinvested in new bonds, helping to manage interest rate risk and provide a steady stream of income. Laddering is a popular approach for investors seeking stability and flexibility in their fixed income portfolios. Tax treatment varies depending on the type of bond and the investor's location. For example, interest from municipal bonds may be tax-free at the federal or state level, while corporate bond interest is usually taxable. Understanding the tax implications of different bonds can help you maximize your after-tax returns and make more informed investment choices. Bonds can be purchased through brokers directly from the government or on the secondary market. Each method has its own advantages and considerations, such as fees, minimum investment amounts, and liquidity. It's important to research your options and choose the method that best fits your investment goals and preferences. A well-constructed bond portfolio can provide income, diversification, and stability. Consider factors like your investment goals, risk tolerance, and time horizon when selecting bonds. Diversifying across different types, maturities, and issuers can help reduce risk and improve returns. Regularly reviewing and rebalancing your portfolio ensures it continues to meet your needs. Bonds and stocks are both important components of a diversified investment portfolio, but they serve different purposes. Bonds provide steady income and lower risk, while stocks offer higher growth potential but with more volatility. Understanding the differences between these asset classes can help you build a balanced portfolio that aligns with your financial goals. Best time to invest in bonds depends on your financial goals, market conditions, and interest rate environment. Bonds can be especially attractive during periods of economic uncertainty or when you need to preserve capital. Regularly reviewing your investment strategy and staying informed about market trends can help you make timely decisions about bond investing. Investors sometimes make mistakes when investing in bonds, such as chasing high yields without understanding the risks, failing to diversify, or ignoring tax implications. Being aware of these common pitfalls can help you avoid costly errors and build a more resilient bond portfolio. Education and careful planning are key to successful bond investing. We've covered a wide range of bond types and important concepts in this guide. Understanding the different types of bonds, their features, and associated risks can help you make smarter investment decisions. Remember to consider your financial goals, risk tolerance, and market conditions when building your bond portfolio. With the right knowledge and strategy, bonds can play a valuable role in achieving long-term financial success.